Hello and welcome to this short video about the income statement, looking at it from a user's perspective, not really an accounting perspective. The income statement is one of the three main financial statements produced annually by limited companies. The others are the Statement of Financial Position, also known as the balance sheet, and the cash flow statement. The income statement shows the profit earned over a period of time, usually a year, and it is said to measure the financial performance of a business. It is also known as the Statement of Profit or Loss, or the Profit and Loss account. A simple example looks like this. Most users would like more information about the costs and who is supposed to keep them under control. So they are divided as follows. The cost of sales is the responsibility of the managers in charge of purchasing and manufacturing. The operating expenses are the responsibility of the general manager or the CEO. Interest is partly the responsibility of the finance manager from the point of view of interest rates, but it's also the responsibility of the board of directors and what their policy is about how the business is to be financed. And taxation is partly the responsibility of the finance manager, but also, of course, is subject to government control. The cost of sales, incidentally, may not be relevant for a service business. Right, so here you can see the costs broken down on the income statement. This is further developed by adding a subtotal after each of these costs, and this is the way you usually see it. Right, the subtotals you can see here are often considered to measure the performance of different parts of the organisation, although the focus on actual revenue or costs is probably more straightforward. However, we'll look at these subtotals. So the gross profit is said to be a measure of the success of the people responsible for buying and selling, or also manufacturing if you're not just buying. The operating profit is a measure of success of the people responsible for the business operation, regardless of how it is financed. And the profit before taxation is a measure of success for the whole business, but ignoring the distortions caused by tax rules or imaginative tax planning. The profit for the year belongs to the shareholders, and therefore it is part of the company's liabilities. The company owes the money to the shareholders. It is added to the equity or shareholders' funds on the Statement of Financial Position, minus any cash that has been paid to the shareholders as dividends. Right, so let's just have a look at 4 examples. In column A, everything looks okay and they're making a profit. So let's assume they're 4 different companies. So company A looks okay. Company B is very, very similar, but this one's making a loss. And what's happened with this company is its operating expenses have got worse. Okay, so the people who are responsible for those expenses, the general manager and other managers within the business, need to do something about that. Company C doesn't have that problem, but it does have a problem. In this case, their cost of sales has got higher. So that's either the purchasing manager or the manufacturing manager who's causing the problem there. And company D the problem there is not the cost of sales, it is that the sales revenue is smaller than all the others. Therefore, that needs to be fixed by the sales manager. And that's pretty much all the key information about the income statement. There are a couple of other points we should probably mention at this time. The first one is if there is income from some activities not usually included in the gross profit. For example, profit on the sale of a non-current asset like a building, for instance. So this is shown as other income within the operating profit, but after the gross profit. And another point you should probably be aware of is the way the cost of sales is calculated. This is sometimes shown on the face of the income statement, but not always. So it's not just the purchases, it's the purchases plus the opening inventory minus the closing inventory. If a business manufactures its products, then instead of purchases, it will be the cost of the goods manufactured. Right, the presentations we've been looking at are typical for the published accounts of limited companies. If an income statement is produced for internal use, it would usually contain more information, and in particular a more detailed breakdown of the expenses. An income statement for a sole trader would not show taxation because unincorporated businesses do not pay tax, although their owners obviously do. As with companies, the profit increases the liability to the owner on the statement of financial position, and here it's known as owner's capital. If you'd like further information about this, we've also got a video on the statement of financial position, and other topics can be found by following the link here. I hope you found this video useful. Thank you for your attention.